Hello and welcome to today's session, Adapt or Die, Navigating Drastically Shifting Fraud Patterns. My name is Mike Sisk. I'm a contributing editor at American Banker, and I will be your moderator today. So as we move beyond pandemic times, the shifting fraud landscape poses new challenges for financial institutions. This webinar will explore the dynamic shifts that have taken place in fraud attacks in retail banking. On today's webinar, we have industry veterans from the Consumer Financial Protection Bureau, Aite-Novarica Group, and Socure, who will provide new insights and trends in synthetic fraud, third-party fraud, and first-party fraud. Our expert panel will also discuss what banks are thinking about with new regulation and what actions they are planning to take in response to the changing environment. So we have got a lot of ground to cover today, and we'll have a short window of live Q&A, but we do encourage you to ask questions throughout the presentation today, and we will definitely follow up with any questions that we don't get to. So please just pop that question into the queue whenever it occurs to you. Now, we're going to actually start things off today with a poll, and I'm just popping up there now. It's going to pop up in a separate window, and so you can kind of take your time to vote on this poll. But it's which of these fraud threats will be the primary focus of your organization to mitigate in 2023: synthetic fraud, third-party fraud, account takeover, money mules, or something else. So if you could weigh in on those on that poll, that would be excellent. And in the meantime, while you are considering your answers to those to that poll, I would like to introduce our panel today. First, we have Mike Cook, Vice President of Fraud Solutions at Socure, who works alongside data science, product, sales, and the fraud investigation team to help ensure solution optimization across all the markets Socure serves. Mike has been an innovator in fraud, identity, and credit risk for over 35 years and has created several patents for identity risk technologies. And we are delighted to have Mike with us here again today. And next we have Leslie Parrish, Deputy Assistant Director at the Consumer Financial Protection Bureau with a focus on consumer credit, payments, and deposits markets. Prior to her current role, Leslie was a senior analyst also with Aite Group's retail banking practice focusing on consumer lending. She was one of the initial employees of the Consumer Financial Protection Bureau as a federal financial regulator. Her role entailed engaging with lenders and helping to develop the Bureau's strategy and policies related to small donor loans offered by banks, non-banks, and fintech firms. And also very, very pleased to have Leslie with us here today. And lastly, we have Trace Fouché, Strategic Advisor at Aite-Novarica's Fraud and AML practice, covering fraud and data security issues. Prior to joining Aite-Novarica, Trace was head of the fraud strategy for SunTrust Bank, where he was responsible for developing, managing, and articulating strategic investments and transformation initiatives that sought to improve the balance between loss prevention, client experience, and operational expense. In addition to these responsibilities, Trace partnered with stakeholders in various business units, including product, technology, and risk management, to govern and oversee the bank's fraud program. So there you have it. Those are our three panelists. It's an impressive lineup, and I'm excited to kick things off. But before I actually turn things over, let me just quickly run through our agenda here today. We will be starting off with the consumer fraud observations from Aite-Novarica and CFPB. Then we're going to have an open panel discussion with all three of our panelists today. Then Mike Cook will be talking about shifting synthetic fraud patterns from, and that will be the thoughts from Socure. And then we'll be moving into that Q&A that I mentioned at the very top. So that is our lineup. And I think with my little opening spiel done here, I would like to officially turn things over to Trace to get the ball rolling. Trace, the floor is yours.
Thank you, Mike. It's a great pleasure to be here. And we're going to start, as Mike mentioned, with taking a little bit of an overview of recent events and trends and consumer fraud in the North American market. So every year around September, we survey over 30 fraud executives from FIs in the US and Canada about what trends they're seeing in terms of attack rates and losses. Up until 2022, application fraud, account takeover, and first-party fraud, which is to some at least application fraud by another name, have been the most aggressively growing forms of fraud. While these types of fraud did indeed grow in 2022, the pace at which they grew was dwarfed by the pace of growth in check fraud and in scam activity. This is a notable shift in patterns and has alarmed a lot of fraud executives. I could spend probably an entire additional webinar talking about the nature of the alarm about check fraud, but the nature of the alarm around scam activities is why we're here today. The significant jump in scam activity has a lot of fraud executives concerned for two notable reasons. First, while they are not currently, at least, legally obligated to reimburse induced fraud, so long as the customer was the one who properly issued the payment order, they understand and acknowledge the significant harm that is done to the relationship when they're put in the very awkward position of having to explain that to the growing number of scam victims. Second, while they would very much like to do something that would be much more effective at protecting their customers from these kinds of attacks, there are unfortunately not a lot of options other than proactively communicating with them to ensure that they're aware of the warning signs and risks. So the market for scam detection and intervention systems has been virtually non-existent outside the markets of, say, the United Kingdom, whereas the scam trend has been growing at this rate for the last 10 years or more. The general consensus among most fraud executives is that scam activity continues to grow at the same pace. If it continues to grow at the same pace, and if the response to controlling for scams does not change, then the risk to reputational damage and the likelihood of a change in regulation that would shift liability for reimbursement will increase to much more uncomfortable levels. This is precisely why we at Aite-Novarica, as well as a lot of fraud executives, have been paying particularly close attention to what's been happening in the United Kingdom and how they've grappled with the growth in scams in that market. The feeling is that what happens in the UK is likely to end up happening here and in other markets around the world. From our perspective, that's very much what's in the process of unfolding. There are a variety of implications that come from this. The first and the most notable is a global trend that we've observed among regulators and the networks to place greater emphasis on the accountability of receiving banks when it comes to reimbursement. This, in turn, I think, raises questions about how to receiving banks would automate the kinds of risk decisions that would need to happen within a very short window of time. So the speculation is that if all of this unfolds in the manner in which many expect it to, then investing in capabilities that enable financial institutions to proactively detect mule accounts will be much more appealing than it is currently. So that is a real quick summary of some of the observations of the trends that we've seen in consumer fraud. And Mike, I'll hand it back over to you.
Excellent. Thank you, Trace. Thanks for setting that groundwork for the discussion today. Leslie, let me turn to you from the CFPB standpoint. Where's your focus?
Yeah, so, first I just wanted to say thanks also for inviting me to be part of this panel. This is a really important topic, especially given all the things Trace just walked us through. And at the CFPB, we've been looking into how fraud is creating significant risk to consumers as they attempt to conduct their everyday transactions, whether those be with businesses or with other consumers. And we're looking at two different types of fraud: unauthorized fraud, like account takeover fraud, but also induced frauds or scams, where a consumer is tricked into sending money to a fraudster or is somehow unwittingly facilitating a fraudulent transaction. And I'll include in that last bucket things like romance scams and scams where a consumer pays for a good or service that's never actually provided. In all of these scenarios, the fraudster is moving funds or inducing the consumer to move funds into the fraudster's account. And there's really a natural tension between giving consumers a frictionless experience and creating the necessary speed bumps to protect them from being defrauded by a scammer or having their account compromised. If we kind of zoom out to a higher level, fast, frictionless, and cheaper payment systems can really offer significant benefits to consumers. These types of payment systems can allow them to instantly pay friends or send money to relatives overseas at lower costs. They can also help small businesses succeed with quicker transactions, lower costs, and more revenue conversion. And faster settlements can reduce the need for families and businesses to borrow, especially when we think about consumers who live paycheck to paycheck. That might be especially important to them.
Leslie, could you give us some examples?
Mm-hmm. Sure. We can use the P2P payments market as an example. So adoption of P2P by consumers as a digital payment method has really been growing for years. And then the pandemic, of course, really accelerated that trend. A recent Pew survey found that about 3/4 of American consumers have used at least one P2P payment provider. Financial institutions see this trend, and as a result, many have told us that they view having a P2P capability as a must-have offering, in addition to any non-bank payment apps that their customers may be using. So really the expanding use and reliance on these services has also made them a nimble tool for fraudsters. And this is presenting real risk to consumers, as well as to our overarching goal at the Bureau to facilitate a fair, transparent, and competitive marketplace that works for consumers. If we look at the complaint data coming in from the FTC's Sentinel database, as well as our specific complaint system, that's one of the many inputs into that database, in Sentinel, we see that $2.7 billion was lost to imposter scams last year. Things like romance scams or fraudsters claiming to be the government or a relative in distress or their bank or another business that a consumer knows and trusts. And the number of fraud complaints is now second only to identity theft reports in terms of total numbers. In terms of the payment method used when that fraud occurred, there's over 62,000 reports of fraud that involved payment apps or services. So that ranks third behind credit cards and debit cards. And if we look specifically at complaints that come into the CFPB complaint database, about half in 2021 of consumer complaints about P2P payments had to do with fraud or scams. So I would say, we're monitoring the market and in some instances taking action when it's appropriate. So one example in this specific market was an update to our compliance aid for electric funds transfers to address how error resolution stemming from P2P fraud should be addressed by the various parties that are engaged in that transaction. And that aid addresses common questions that we've been receiving at the Bureau about P2P payments, like how P2P payment providers resolution obligations. The aid also discusses the fact that private network rules don't override consumers' Reg E protections.
Thanks, Leslie. Mike, do you want to weigh in here?
Yeah, sure. Thank you very much. And again, also great to be here as well. So all this discussion about money mules really kind of what I think about when I think about money mules, it is basically probably the most misunderstood fraud vector that we have today in the industries that we serve from Socure's perspective, and then of course from American Banker and the banking environment. I think we understand application fraud very well. We understand other kinds of fraud, but money mules is something that we have a lack of understanding, I believe, as an industry. Today, most of money mules and the protections against that are done using behavioral characteristics within the account. But mules are smart. They have the ability to kind of hide underneath certain levels, certain SARS levels, certain performance or behavioral characteristics, right? And so these money mules have kind of had free reign for a while, and they've continued to grow. We'll talk in a little bit about synthetic fraud and kind of how that's impacted money mules following COVID. But the interesting, unfortunate, thought-provoking thing for me is if there are changes to who takes the loss in a P2P scam or somebody else's or some other kind of a scam, right? If it's in whatever kind of payment vehicle it might be, we have money mules that we don't understand too well. And that pattern of money muling is going to shift drastically, right? If there's a change and a shift made to who's liable for it, right? Because think about it. There's going to be an increase in first party fraud. There's going to be an increase in second party fraud where the consumers are actually partnering with the fraudsters to perpetrate money muling scams, right? And why is that? Because they'll no longer be responsible for the loss. So that will create an opportunity for them to, be a part, take a more active part in money muling. And that is something that we don't really have a good idea, a good understanding of. And I've talked to a couple of banks about this, and each one has fallen into the trap of saying, well, we'll look at device data, right? Because we know if it's first-party fraud and they use their device, that we can tag them with, well, you made this transaction, right? What everybody needs to understand is that's not going to work in this environment, right? Because in a money mule situation, right, in a scam situation where the consumer's been scammed, if we say, well, you made this transaction for your device, the consumer's going to say, of course I did, right? I was scammed. And so device isn't going to work. What really we need to do is pay a lot more attention to money mules, not just behavior, but the identity of the money mules, right? Because how does a money mule get into an account? It gets in there through synthetic, and we'll talk about that. It gets in there through third-party fraud. It gets in there through account takeover, right? You also have first-party and second-party fraud, and then you have victims that you got to pay attention to. How are we going to tease all that out? I think we're going to have to tie identity with transaction information to get a better understanding of where the transactions are coming from, who do the receivers look like, who do the senders look like. And a lot of that work is cut out for us. We need to get it done, but we haven't started that. We're doing some things at Socure to try and get out ahead of that. But, all of the discussion about money mules, all the things that we're seeing, the points that Leslie made, I think we are at a lack of understanding. And I think that what we do understand is going to change completely if we see some kind of liability shift in the coming months or years.
Yeah, if I might, I'd love to pick that thread up, Mike, and just ask, because from our perspective at the CFPB, we're really interested in understanding any steps financial institutions are already taking or maybe considering to address the money mule account issue, especially when it comes to banks that are on the receiving end of that transaction. So, Mike and Trace, maybe a couple of questions for you along those lines. First, how are the FIs who serve as receiving banks in a given transaction thinking about their roles or responsibilities? And then how are P2P payment services and FIs interacting, and what gaps or breakdowns exist when fraud occurs? In your experience, do you see FIs wanting to see changes in how P2P companies resolve fraud complaints, for example?
I think those are great questions. With regard to how receiving banks are thinking about their roles in all this context, I think Mike pointed it out pretty well. It has a lot to do, or it will depend pretty heavily, I would say, on the whether or not they will be held liable for any kind of the reimbursement burden. Generally speaking, though, I would say, the thinking there is changing. It's undergoing a great deal of metamorphosis at the moment because there's so much uncertainty about exactly what that liability burden may be. Monitoring for inbound payments, it's long been a consideration, but until recently, there hasn't been much in the way of an economic incentive to take those considerations terribly seriously. Put more deliberately, there hasn't really been much of a business case for investing in those capabilities, despite the relatively unanimous agreement among fraud executives that it would be a good thing to do. Ultimately, I think it comes down to the degree to which there's a business case that supports the investment. And in the absence of a directive from networks or a directive from like a regulatory requirement or an economic motivation that would come with either or both of those, or from reputational risk, which is also growing, then I think there will be a good deal of consistency in whether and how FIs monitor for inbound payments. And the reason I talk about inbound payments too is because that, to me, that's where that would be how and why the business case for investing in proactive mule detection would come from. With regard to the second part of the question, do FIs wish to see changes in how P2P networks resolve fraud complaints. I would say that most are very uneasy about the current state of things. So there's an acknowledgement that something needs to change. I think there are a lot of differing opinions about what those changes should be. I will say this, though. I think the vast majority of fraud leaders I know are pretty well motivated to make improvements. And that most would also agree that the networks must play a really central role, a very important role in controlling for fraud in general, but scams in particular. So where this becomes particularly important, though, is in the scenario where the receiving bank may be held liable for some portion of the reimbursement burden. If every inbound payment has the potential to become a liability, then depending on the details of what separates legitimate inbound payments from fraudulent payments, screening these could be prohibitively costly for a lot of FIs. And then there are questions of whether they even have the legal or contractual authority to intervene with the depositor's access to the funds based on the risk models that are, as the old saying goes, often wrong, but sometimes useful. So, in my mind, the key here is automation. And automation will depend on the FI's ability to predict whether the identity profile of the beneficiary account holder fits that of one of many mule profiles. That ability would be greatly aided by intel from the network and from being given the authority to place holds and or conditions on funds availability by regulators and network operating rules. So there are a lot of details to work out here.
Yeah, and Trace, as always, it's a bit of a mind meld between you and me on these things. And what I'll do is, I know Leslie had started the question by asking about the receiver, but let's talk about the sender for a little bit. What I've seen is that generally it's the sender, right, that is trying to pay more attention to the loss, right, because it's their consumer. They're trying to protect their consumer. They know they're not going to take the financial loss, but I think that reputational risk is something they're concerned about. And so generally in P2P or other types of scams, wire transfers, whatever it might be, before the consumer sends it out, they are trying to protect that consumer. We've seen an uptick by the sending banks to pay more attention to credentials where they are sending the money, right? It has the consumer seen, have they sent this receiver before? Of course, that's been in play for quite a while. But what we're seeing now is more risk assessment of the credential itself, right? We have risk scores at Socure. They're focused on email risk, phone risk, address risk, right? And so the credentials for P2P are going to be the email or the phone. And so we're seeing more of the senders starting to pay more and more attention of, hey, is this a risky credential? Can I do some assessment of this behind the scenes? Don't add friction to the consumer, right? And then, protect my consumer a little bit there, right? So on the sender side, I am seeing an uptick in focus on trying to protect their consumers. And again, to Trace's comment, I think that's more probably reputational risk and having to deal with a consumer who's upset if they do take loss. On the receiver side, it's unfortunate, I think. I've been in this industry, trying to stop fraud for now over 35 years. And Money Mules has always been this misunderstood, not really well, documented financial loss, right, that takes place. But because the bank, right, the deposit institute doesn't take the loss on it, there's been very little interest. And I'll show you some numbers here in a bit, right? But there's been little interest in identifying the money mule and stopping them. And again, Trace and I agree with that. A good example of that is synthetic fraud. We think synthetic fraud has really changed and is attacking deposit accounts now. And when we do assessments of fintech data, of banking data, anybody with a deposit, we see that 1% to 3% of open active accounts in the U.S. are synthetic, right? Those synthetics are money mules, right? Mostly in a DDA or deposit account, because it's not like a card where they can take you for a loss, right? Or it's not like for an auto where they can have the car for a while before it's repossessed, right? So we have not seen the banking industry pay much attention to keeping the money mules out of those deposit accounts. And the unfortunate truth is that some of those money mules are actually profitable accounts, right, for the banks. And so I think there hasn't been the attention in the past. I will say in the last quarter, probably 2 quarters, at Socure, we've had some bigger, more sophisticated fintechs and banks reach out to us and say, hey, we realize we have money mules in our system, and we'd like to identify those in our system and shut them down. So we're doing things called portfolio scrubs, where we can score, right, the identities in an account, and we can help point and say, look, this 0.8% for one customer where they do a pretty good job of keeping things out at the front door. We have another very large bank that has over 4% of their accounts that are synthetic accounts that are open and active, right? And so we have a really good, nice way of saying these are the accounts that you need to get out. So I think what can the receiving banks do? Number one, really, really, really protect the front door, right? If you're using CIP as your synthetic solution, that is not going to be it, right? That's not going to do it, and synthetics are going to slip through. If you're not using a synthetic score, right, and you're trying to use something homegrown, of all the frauds that I've tried to help stop over the years, synthetic fraud, you need a consortium. You need to work with an outside company. So work with an outside company and implement something to keep synthetics out of the front door, keep third parties outside, right? Don't let them in. But realize, right, that for years they may be slipping through, and these synthetics, these third parties acting as money mules, they are in your accounts, and they are going to wreak havoc. And if there is a change in liability shift for fraud losses, right, and those go to you, if you're not watching, I mean, those are going to pop over to you immediately and could double your losses from at least synthetic fraud, overnight.
Really interesting. Thanks, Mike and Trace both. So, Leslie, let me turn back to you. Can you speak to the CFPB's position on what you're looking for financial institutions to do in lieu of current regulations?
Sure. What I can say right now, Mike, is that we're carefully monitoring the risk to consumers that are spurred by money mules and other fraudulent activity for bank accounts and payment apps alike. And we're also looking at what types of actions market participants are undertaking to lower these risks, and the extent to which those fraud detection and mitigation efforts are moving the needle at their institutions. And of course, we're looking at risk to consumers as a whole, but I would say we're also focusing on how fraud is impacting specific consumer segments. For example, older Americans or service members. So just to give you a couple of examples there, we published a report last fall on elder financial abuse and the extent to which older Americans are able to recover from different types of fraud. And what we found is one factor that influences recovery is the payment method involved. So payments by credit card, for example, much more likely to be recovered than payments by wire transfer or P2P. So in terms of policy implications, in that report, we noted the need for greater fraud protections on P2P payments in particular. When we think about service members, they often have to move to a new area, sight unseen, maybe even from out of the country when they're assigned to a new post. And when you think about how competitive the market has been to secure rental housing and a car, they may feel like they have to put a deposit down without actually seeing that house or that vehicle. And the same might go for securing childcare or moving services to that new location. And that dynamic has also created an opportunity for fraudsters to post fake listings for really non-existent items or request an upfront deposit, also typically through a P2P payment service. So we're looking at this, broadly for all consumers, but then also, how this has particular impacts to particular consumer segments.
Yeah, so much to consider. Thank you. So, Mike, let's at this point talk a little bit about the shifting pattern Socure is seeing today. So with the SVB Signature Bank and market turbulence, what are you seeing?
Sure. So I'll cover that, and then I'm going to cover a little bit about a little bit of synthetic trends that have changed pretty substantially, right? I've been tracking synthetic since it's been around, over 20 years, and it really has had the biggest change in pattern that I've seen during the time that I've been watching it. But for SVB and kind of, following that, we had some concerns, right? Because when that happens, and you've got a lot of consumers are going to make changes, you have the concern that there could be panic, right? We were all hoping there wouldn't be, and it looks like, we're doing pretty well at this point. But we started monitoring kind of changes in patterns, shifting patterns, as you would imagine with the closure of SVB accounts. There's a lot of accounts that were moving to other generally larger fintechs, of course, traditional banks. And we were concerned that there would be fraudulent patterns that happen there, and then also an ATO. So we do track all of the applications and account non-mon changes that happen, which are, of course, a catalyst for account takeover. And what I can report to you is that there hasn't been what we thought would be the biggest changes in traditional banking, right? We thought there would be more attacks there. What we are seeing is that in small business and investment accounts, right, we are seeing almost a 400% uptick in synthetic fraud attacks. So when we do an analysis, we generally will look at attack rates. We'll use our Sigma score as a proxy, right, for that. And so when we see that Sigma score at 0.99 and it increases, right, over time, we always see these bounces up and down, right, from fraud attacks that are happening and slowdowns. Over the weekends, of course, there's always an uptick. But for small business and investment, we did see a pretty substantial, almost 400% increase in attack rates to that industry. The other industries were, kind of falling within the norms. So we were very happy to see that it's not attacking across all industries. But if you do have a small business and you're receiving applications, if you have an investment accounts and you're receiving applications, if you don't have synthetic controls, you should recognize that those did happen at a really increased level on the Thursday following the Friday closure. So we think, they may, bad actors probably watching Twitter, right? Paying attention to the news accounts that before they actually kind of get made generally, and wide. So we saw that happen. We did see a slowdown, and we're still seeing an increase in synthetic fraud in that market. So it went up, right? It's come down, and now we're starting to see it's still starting to tick up. So small business investments accounts should be concerned about that. At ATO, we thought that non-mon changes, there'd be a lot of non-monetary changes to accounts, right? Consumers are thinking more about their bank accounts these days, right? So even if they didn't shift, they may be making changes to their phone numbers or emails because they want to get notified, right, on time, and you may have an old account. And so we do monitor the risk of that as well. We've seen the risk come down, actually, if you look at it from a fraud rate perspective. And we believe that is most likely because of the increase, right, of good people changing, right? And so the fraud attacks that are happening there are going to happen at a lower rate. So far, right, pretty good news. Following SVB, we don't see the massive attacks that we thought, but in those two industries I talked about, we are seeing it there. But let me talk to you about probably the biggest news, I think, today in our market is synthetic fraud. Synthetic fraud, if you recall, years ago, 20 plus years ago, right, it was mostly attacking cards, right? And they were doing real quick, let me run it up, let me take the card for what I can. You're going to try and find me. You can't find me because I'm not a real person. And it generally was getting pushed off to credit losses, right? So early days, credit cards, and then also wireless phones, right? Because back then, if you recall, for those of us who remember, you could get a free phone with a 2-year account, right? So if you would sign up for 2 years, you get that free phone. So synthetic fraudsters were attacking that, taking the free phone, taking it, selling it in Europe and elsewhere. And so that's changed a little bit now. You have to actually finance that phone. And so synthetics has changed the behavior a little bit there in the telco space. About 10 years ago, we saw synthetics doing a little bit more bust out activities. They started to get more comfortable, being a little bit more patient with it, right? And then what we wanted to understand, because we started seeing banks, deposit accounts, right? Savings, investments, anywhere you can move money in and out. We started seeing the attacks get higher. So we did this analysis here where we looked at synthetic fraud. And again, we were looking at attack rates. So we're using our Sigma synthetic score as a proxy. If it scored above 0.99, it looked like it is an attack from, in a synthetic bad actor. And so what we saw is that since COVID, during COVID, right, and you can see here, fabricated patterns are, it's a type of synthetic where it's completely fake. The manipulated pattern is a type of synthetic where it is tied to a real person who's changed their identity enough to get a new credit report, right? And what we were surprised to see, because this is massive shift, is that synthetic fabricated identities are attacking deposit accounts at an extremely high level, right? And you can see during COVID, there was a big peak. And then in 2021, we saw a slow increase, which continues today, right? And the only reason that could be is because bad actors realized, hey, I can have money mules. I can talk people into, moving money for me. I'll have to give them a skim of that transaction, or gosh, I can just create a synthetic identity, right? And then I can use that synthetic identity as a money mule. I don't have to give away any of the skim of the transaction, right? And I can manage that all myself. And so synthetic fraud has really changed its behavior. If you do have deposit accounts, you have not noticed this change, right? It's really important for you to start to pay attention to originations and synthetic frauds, because there's only, there's nothing good that's going to happen with a fabricated synthetic identity in your account. They're going to be used as money mules to fuel activity. They're going to be used to move money for money laundering, for sex or human trafficking, or even terroristic activities, right? We've seen some of the states, we work with some of the states, and we've seen that driver's licenses, people are trying to open up driver's license in fabricated synthetic identities. And so, again, everything from money mules to terroristic activity, nothing good, right? And so this trend continues to happen. And again, we saw it not only in DDA accounts, but we saw it in investment. And it's interesting here, if you see, same pattern, fabricated is the fake one, that's the red line. We tracked it starting COVID, following COVID, right? And what you can see is that I think the synthetic bad actors started realizing later, right, that, oh my gosh, I can open up any kind of an account. It doesn't have to be DDA, as long as I can move the money. And so we saw these increases here that happened later in 2021. These things peak up and down. And in investments, it's interesting, right? Just following SVB, we did see these investment accounts being attacked at a higher level. So, synthetic fraud has really changed its behavior, especially for this community on this webinar. This is really an attack at you, right, to create more money mules. And in P2P, if there is a shift of liability, these accounts are open, 1 in 3, one to 3 of every 100 accounts you've got, and they are going to be used for continued money mule. One thing that is another interesting thing, and this is for a new study that we are doing. We should be releasing this in the next month. We wanted to do the same study that we did earlier. We released that synthetic study back in October of last year. And so we're redoing the numbers. We want to see kind of what's the change been since we ended that chart last time for synthetic. But we also want to understand third-party fraud and how is it reacting with synthetic fraud. And we pull this out of the report. It's going to be in the report if you want to see it in a month or so. But this shows you synthetic fraud versus identity fraud. So instead of being synthetic, fabricated, manipulated, this chart is talking about third-party fraud, identity fraud, right, and synthetic. And there was a massive uptick in attacks from third-party fraud, as you can see here. But for the first time in my lifetime, synthetic fraud is increasing above the rate of third-party fraud, right? And it looks to be continuing to increase and separate out further. So while it was always third-party fraud that was leading synthetic fraud from a volume perspective, what we're starting to recognize is that we think these patterns are continuing to shift, and that synthetic fraud is probably going to outpace third-party fraud in 2023 and maybe into 2024. So that's some of the interesting things that we've noticed. The concern that I've had for money mules has been around for over a decade, right? And I think it is because of the lack of the liability that they've got, right? And so the things that Trace has mentioned. But we do a study just like we've done here on this webinar, and we've done it for several webinars in the past. So this is analysis that we've seen from both private sector and public sector. And this is thousands of responses, right? And what you see is money mules is always, right, the smallest concern when we poll, participants in the webinars that we participate in. And so you can see synthetic fraud, third-party fraud, account takeover. Really, people are concerned about these things, right? Money mules, they're not. And so, if I had to make a prediction, right, 2024 will be the year where we as an industry pay a lot of attention to money mules. And I think money mules is going to be number one next year when we ask this question, which one are you concerned about the most? And so, I'm personally excited to see that just because I do think money mules really impacts consumers in the United States. Not just from a financial part, but emotionally, right? When they get scammed, it's a big emotional impact to them. So I think this pattern is gonna change.
Let's hope so.
Awesome, thank you, Mike. And we are now at the promised Q&A. So if you've got something on your mind, now would definitely be the time to get that question into the queue, but we've got some good ones here already, so I think we should just jump right in. And Trace, let me lead off with you on this one. So how do you think the rise of cryptocurrency and other digital payment methods will impact the fraud landscape in the financial industry, and what steps can be taken to mitigate these risks? Come on now.
Well, I laugh because the first thing that comes to mind is what an old admonishment from my mother when I was growing up. She used to say that, whenever I told her I was going to be out past 12, she used to say, nothing wholesome happens after 12. And the same thing kind of comes to mind when I think of crypto. Nothing wholesome happens around crypto. Now, that's not entirely fair, of course, but there is an enormous, maybe an outsized amount of criminal activity surrounding crypto, and it has certainly been a vexing problem for a lot of people. There's a lot of scam activity related to crypto and exchanges. So, with regard to the question, what will this mean in terms of impact for fraud? In the fraud landscape of the financial industry, and what steps can be taken to mitigate these risks? Well, I think a lot is already being done. I mean, I know a lot of the crypto exchanges are working hard to beef up controls around scam detection and fraud detection capabilities, and a lot more needs to be done. But similarly, I know a lot of FIs are paying very, very keen attention to any kinds of monetary transactions related to crypto. I mean, I would stop short of saying that it's a red flag anytime you see it, but it certainly should warrant maybe a little bit extra scrutiny. The one thing that's a big mystery to me is exactly where things are going with regard to crypto. So it's kind of hard to say how that will impact fraud if I don't have any crystal ball in terms of what's going to happen with crypto. I mean, generally speaking, I would imagine we'd see a good deal of diminishment in terms of activity there. And so therefore that might be a good thing. So yeah, it's a good question. I don't know, Mike, if you have any thoughts on the matter too. You've always got some great insights here.
I wouldn't. If anything, I would just replicate exactly what I just did about crypto, and I think it's gone through quite a bit of change in the last year. Of course, it used to be used a lot more aggressively. I think with some of the problems in the crypto market, it's slowed down a little bit, thankfully, from a fraud perspective. And so, like you, I do wish I had a crystal ball that could help me understand what might happen with crypto in the future and fraud vectors.
Maybe one other thing I'll tack on to that, and that is that, crypto is usually the last thing to happen, or one of the last things to happen. In other words, if at least in the fraud life cycle, right? So if let's say a scam takes place from a bank customer, they're gonna transfer the money to a mule account. Depending on the payment network, they're going to do that as many as 6 or 7 times. So that's a really interesting insight that came to us from Vocalink several years ago when they did a study on Britain's faster payment service. They looked at money mule transfers, money laundering transfers at the network level. And what they were finding was that now that they had access to instantaneous settlement payment rails, the money movement was happening as many as 6 or 7 times a day. Now, I'll point that out because it's kind of interesting because, for those in the know, it's very difficult to track that money movement more than once or twice, much less 6 or 7 times in a single day. But my point is that usually at the end of all of that money movement, they're cashing out somewhere, and that's usually crypto. Usually ends up in Bitcoin or some other form of untraceable monetization of it. And so that's another important thing to keep in mind when you think about crypto.
Interesting. Leslie, let me turn to you with a question. So how can financial institutions and regulators work together to stay ahead of fraudsters and mitigate risks in a constantly evolving threat landscape?
Yeah, so I would say, from our perspective, we definitely want to continue to plug in where we can be helpful here, and also continue our outreach to financial institutions and other companies in the market so that we can have a good understanding of, what they're doing, what investments they're making, where they see gaps and breakdowns. I think importantly, where there might be market failures to address that they can't do on their own. But also on the flip side, whether they're seeing a growing appetite within their own institution or within the industry for making new investments, or whether things are improving. So overall, I just say that this continues to be a key area of focus for us and the impacts to consumers.
Excellent. Thank you. All right, here's another good one for Mike. Let me ask you this one, but again, anyone chime in. But what advice would you give to small and mid-sized financial institutions that may not have the same resources as larger institutions to combat fraud and cybersecurity threats?
Yeah, it's a great question. I think it's a good question. I think because they are smaller and they may not advertise as much, right? I mean, a lot of times advertisement is read by fraudsters as well as consumers, but they may not be attacked at as high a level. That said, they still have to have protections, right? So I think the first thing I would do if I was small or mid-size is, make sure I have all the protections that I need at the front door. So if you're working with a core processor, you're working with an application processor, right? I'd imagine they have a synthetic fraud solution that you could use. I'd imagine they have a, identity fraud solution they can use. I'd imagine they may have a first-party fraud solution. Test those solutions that they've got. If they're not good enough, raise your voice, and let them know. You need to get better vendors into this process, because a lot of small to medium guys tend to process through the core processors or through the application providers. And so there is just the need to make sure that you are working with the right companies to stop the fraud at origination, right? You should look at your process and figure out, what are the fraud. If I was a fraudster, how would I beat my system, right? Because they're doing that, right? I mean, we see it all the time. They're trying to figure out if I can beat you on mobile, if I can beat you on the PC, if I can beat you physically, right? And they're going to test those channels. And so just if I were medium or small, hey, how would I attack myself, right? And that's something I would do. And then one of the last things is, when you do find somebody who is suspicious, right, you want to step them up, right? And a lot of the small and medium guys are still using knowledge-based authentication, KBA solutions, to step people up. You guys, please stop doing that. That technology was old the day it came out, and it's never really worked. It's going to give you a lot of false positives, false negatives. So if you're using KBA today, please do me a favor. Look at other solutions, right? There's a lot of document validation companies that are out there where we can take a selfie, take a picture of the driver's license front and back. And while deepfakes have gotten much better, it's interesting to see those pictures. Gotten much better in the last year. It is something I would do is pay attention to my step up. And then the last thing I would do as a small and mid-sized company is, any non-mon change that happens, right? So if somebody tries to come online and make a change, if somebody's trying to make a phone number change to their mobile, if they're trying to call into the call center and make a change, you really should assess the risk of that new element that's coming to you. If it's an email, if it's a phone, if it's an address, you can score it behind the scenes and you can basically triage that and say, look, I'm going to let 95%, 98% of these things go through and not touch them. And then the last 1 or 2% may be suspicious. So I'll step them up. Again, not to KBA, please. Please step them up to, better technologies that we have today.
Excellent. Thank you, Mike. All right. We are just about, I think I've got time for one more question here. So let me stick with you, Mike, on this one. So how could my organization retroactively identify the money mules or other fraudulent accounts that may have been opened before we implemented stronger defenses?
Great question. Again, what most people are doing is looking at behaviors, right? And when you're just looking at behavior of an account, your false positive rates are going to be really high. Your friction rates are going to be really high. The behavioral assessments are just not as predictive. And that's not a shot against anybody. It's just that it's very difficult, right, to have a great assessment of money mules and their activity using simply behavior of the account, right? And so what I think the industry is going to move to is this combination of identity and behavior. And to tie those two things together, there's a couple ways to do that. One is at origination, you're going to have good accounts, you're going to have bad accounts that you really step up, and you're going to have these marginal accounts, right? If you've got marginal accounts, you have all these signals that you get at point of origination, right? And what we've seen is the smarter, more sophisticated guys are taking those signals, pushing them forward into their account management system and tying those signals from origination into the behavior, right? And what that does, it's free data, right? Because you've already purchased it, you're pushing it forward. What that does is it helps you better assess, right, who may be a money mule. It's better for you because your false positive rate is going to be lower, operational costs going to be lower, all right? You're going to step up for your people. It's better for your customers because you're not going to apply as much friction to them. So that's one way, right? Simple way, it's free, just push it forward, right? The other way is what I talked about on a portfolio scrub, right? It really does make a lot of sense. Anywhere from 1% to 3%, 4%, just recently on an analysis we did last week on somebody's portfolio, right? Where they were just synthetic. Now that didn't even include third-party fraud, didn't include ATOs, didn't include first-party fraud, didn't include second-party fraud. So understanding money mules in your system, I think you're going to have to go through and do the portfolio review, right? So Socure does that. I'm sure others do it as well. But, talk to your vendor, talk to your fraud solution provider, and do a portfolio review. It takes probably a month to get it done. You'll know exactly how many money mules you have in your system. You'll be able to step those guys up, isolate the bad ones, get them out of your account, right? And then the ones that aren't money mules, you'll be able to kind of leave alone. So those are the two things I would do. Move signals in from the front to your account management. And then also I would definitely, do a scrub and look at my accounts and really try and get those guys out of the system.
Good advice, and I think a great note to end on our program here today. We're just about the top of the hour, and we always do try to be on time, knowing that so many folks are shifting to something else right at the top of the hour. So first of all, I want to thank Trace, Mike, and Leslie. Thank you all for being here. Really good discussion, really important topic. And of course, everyone in the audience, thank you for your time today. And we will definitely follow up with any questions of yours that we did not get to. So if you're not, your voice will be heard. We'll also be sending you a follow-up email that'll have a link to the recording of this event today, and also a PDF of the slides as well. So that will be coming your way. Keep an eye out for that. And with that, I think I will officially wrap it up. Wish everyone a wonderful rest of the day, and I hope you'll join us again here very soon. Thanks so much.